Hey there. Today we're diving into one of the most underrated yet fundamental tools in the world of investing, bonds. This video is your guide through the world of fixed income securities. We'll break down how bonds work, who issues them, why they might even be safer than stocks, and under what conditions you could lose money. Stick around to the end to learn how to avoid yield traps, stay clear of defaults, and pick the right bonds for your portfolio. Don't forget to like and subscribe to support the channel. So, what exactly is a bond? Picture this. A company or a government comes to you for a loan. Yep, not the other way around. They're borrowing from you. You hand over your money, and in return, they promise to pay it back after a certain time with interest. That's a bond, a formal IOU that's registered, traded on the market, regulated by law, and understood by investors. It basically says, the person holding this note gave us money, and we're obligated to return it with interest. Bonds aren't just fancy pieces of paper. They're a whole asset class. Governments issue them. So do cities, corporations, and even international institutions. Each bond issuance is a financial decision. How to fund a new highway, launch a product, or even finance a war. Yep. Bonds have been used to fund some of the biggest conflicts in history. For example, U.S. war bonds during World War II were a huge part of the home front's patriotic effort. But let's not dwell on the gloomy stuff. Back to the basics. Bonds have something called a face value. That's the amount the issuer promises to repay on the maturity date. Most of the time, it's $1,000. Bonds also come with other details: issue date, maturity date, coupon rate, and how often payments are made. The coupon is the interest you earn while holding the bond. Make sure to join our Telegram channel, where we post updates about new videos and articles. You'll find the link in the description or pinned comment. Now, here's where it gets interesting. If you buy a bond on the secondary market, the price might be different from its face value. You could pay $1,037 for a bond that's worth $1,000. Why? Maybe the market sees it as super reliable, or the coupon rate is high. On the flip side, you might get it for $970, maybe because interest rates have risen or people are nervous about the issuer. But no matter what you paid, your coupon is still based on that original $1,000. That's a key point. The return on a bond isn't just the coupon. If you bought it for less than its face value and still get the full $1,000 at maturity, that difference is profit too. That's what we call yield to maturity. It's the most accurate way to compare bonds because it accounts for the interest payments, the price you paid, and how long you'll hold the bond. Here's another concept you need to know: accrued interest. Let me break it down. Coupons are usually paid twice a year. If you buy a bond 3 months after the last coupon payment, the previous owner has earned half of that coupon. You have to pay them that portion when you buy the bond. That's accrued interest. You'll pay it up front, but you get it back on the next coupon date. So how do bonds behave on the market? Their prices go up and down. One major factor is the central bank's key interest rate. If it goes up, older bonds with lower coupons look less attractive. Prices drop. If the rate drops, bond prices rise. That's why savvy investors sometimes sell bonds early and lock in a profit. There are many types of bonds. Government bonds come from the federal government. These are considered the safest. Municipal bonds come from cities or states. They usually offer higher returns, but they carry a bit more risk. Corporate bonds are issued by private companies. They can be solid or risky, depending on the company's stability. But that's not all. There are agency bonds, which are issued by government-backed institutions like mortgage agencies. There are also zero-coupon bonds. You buy them at a discount and get the full face value at maturity. No interest payments, just a fixed return. Another cool type is convertible bonds. They let you swap the bond for company stock at a preset rate. That means you can benefit from the company's growth, and the company saves on interest payments. It's a win-win. But bonds aren't always smooth sailing. They carry risks too. The biggest? Default. If the issuer can't repay you, you lose money. That's why credit ratings matter. Rating agencies score the issuer's reliability, from AAA to D. Bonds rated above BBB are considered investment grade. Below that, they're called junk or high-yield bonds. They can pay more, but they're risky, like spinning the roulette wheel. We just published a new article on our site. It's packed with free content on stocks, bonds, and ETFs. Perfect for beginners and experienced investors. Go check it out and bookmark it for later. Other risks include interest rate risk, liquidity risk, and currency risk. For example, if your bond is in a foreign currency and that currency tanks, your profits disappear, or maybe you want to sell, but no one's buying. That's liquidity risk. All right, let's talk real-world tips. How do you pick a bond? First, check out the issuer. Who are they and how stable are they? Second, look at the maturity. Short-term bonds are safer but earn less. Long-term bonds pay more, but you'll need patience. Third, focus on yield to maturity. That's your main comparison tool. Fourth, check the bond's liquidity. How easy is it to buy or sell? Fifth, call provisions. Some bonds can be paid back early. That's called a call option. It might be voluntary or forced. Sometimes a company says, "We're done paying interest. Here's your money back." If you miss the call date, you might be stuck with a low-interest bond. Bonds aren't just about making money. They're strategic tools. Use them to stabilize your portfolio, generate passive income, or hedge against risks. Pension funds, banks, hedge funds, they all use bonds. Bonds get traded just like stocks. They can rise and fall, but unlike stocks, you usually know how much you'll get if you hold on to maturity. And finally, bonds are a cornerstone of the global financial system. Without them, governments couldn't run budgets, companies couldn't grow, and stock markets wouldn't look the same. Bonds fuel the economy, offer stability for investors, and help businesses expand. Hit that like button and subscribe to the channel. If you want to support our work, check out our membership page. Links in the description or pinned comment.